Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Richard Woolnough, manager of the M&G Optimal Income Fund. Hi, Richard.
Good morning.
So we've heard today the January inflation figures in the UK, 1.8%, a little lower than we were expecting, but still an increase on the previous month. Now, you, unlike some other fund managers, are really impacted and indeed guided by the macroeconomic factors when it comes to investment decisions. So for you, how important is this latest inflation figure?
Like all trends, you're trying to see what's happening next and where markets are going. And it's just a signpost. It's a signpost that we're at full employment. It's a signpost that the economy is strong and will probably remain strong all the way through to, it's still 2 years before Brexit presumably formally happens. In those 2 years, we have the benefits of a very loose monetary policy set by the Bank of England 6 months ago. We have an exchange rate that's very, very low that encourages growth and imported inflation. And we have full employment and strong credit growth, whether it be car sales or the general housing market. So, it's a signpost that inflation is coming back. The question for me as a fund manager is what's priced into the market? And bond yields are still very low in the UK. And therefore, for me, it's a signpost that inflation is picking up and you need to be defensive in terms of taking interest rate views.
And this is not just a UK solely phenomenon, is it? We've seen inflation figures in Germany and across the EU and indeed in the US start to pick up. You say it does impact then your asset selection. Does it force you to have to think, beyond the sort of obvious picks in this kind of market cycle?
As always, you're always thinking about that, where inflation, where growth, where interest rates are going to be. In terms of expanding it out, it's trying to work out whether index-linked securities are good value versus government bonds. So back post when the events of the summer unfolded around Brexit, we changed our duration of our portfolio. We had a bias towards buying index-linked securities because we thought that inflation would pick up and the market hadn't priced that in for some reason. Those markets are now back to fair value. I think the main thing is just thinking about where the world economies are going. Are they healthy and strong, or are we on the precipice of the next recession? I think they are healthy and strong. We're not on the precipice of the next recession, and therefore we generally like to take credit risk because we think recession is unlikely. But we don't want to take lots of duration risk because we think that the economy is not as fragile as maybe the markets or the central banks think.
7.7% return last year for investors. Pretty good looking considering how low yields are across the developed world. Outlook for the next 12 months, can we expect more of the same, or is it a little bit more challenged now?
It's always every year. The good starting point is where the asset class sits and where it yields. And in order to add value, in order to do things to the portfolio, you need, a horrible thing to hear, you need sort of strange things to happen. If the world was calm and stable, then you can't provide excessive returns. If the market panics and gets too excited, then what we can do as value managers is we can add value by not being there when the market's too excited and getting involved when the market's scared and panicking. So it depends how the market unfolds. So if there are events over the year which cause markets to be mispriced, then we can add more value and returns to the portfolio. If the market is calm and benign, then it's a lot harder to add value to the fund.
And finally, will this higher inflation mean a rate rise in the UK?
I'm perpetually, surprised about where rates are. I think the Bank of England has got various measures it needs to do first. They've currently been buying back corporate bonds. That programme is way ahead of schedule, and I think that might come to a close soon as a signal that maybe we're going to put rates up. So I think it'll be a while before they do that, but they've sort of said what they're going to do because they fear what Brexit's going to happen. So it's very, very hard for them to reverse it. But the data, if you just sit here and looked at the data, the Bank of England wouldn't be talking how they're talking. But when you look forward and they still remain very concerned about the events in 2 years' time, that limits their ability and their approach to put rates up. I personally would, but they've got a more forward-thinking job maybe than I have in terms of seeing what happens with Brexit.
Richard, thank you very much.
Thank you very much.
This is Emma Wall from Morningstar. Thank you for watching.